Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Jack in the Box.
If you find our talks useful, please consider subscribe, like, and comment underneath. We really appreciate you tuning in.
Yeah, and before we get into today's stock, here is a really useful chart tool for investors and traders. Like, if you want help reading trading charts more clearly, you're going to want to check out VIP Algos through the link below in the description.
Highly recommend it.
Yeah, VIP Algos is an educational TradingView indicator suite. It shows visual buy and sell chart alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas. It can be used across markets like stocks, forex, crypto, gold, indices, futures, and more.
Right.
Just remember, VIP Algos is an educational chart analysis tool only. It is not financial advice. It does not place trades for you, and, it does not guarantee profits. Trading involves risk, so always manage your risk and do your own research. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Awesome. So I want you to imagine looking at a company whose stock is just, it's in an absolute free fall, down roughly 14% over the last 7 months. Market sentiment is at rock bottom. The chart just looks painful. And it kind of seems like everyone has just walked away from the table, assuming the ship is sinking.
The pessimism is real.
Right. But then they quietly drop their second quarter numbers and they deliver this massive revenue beat that completely shocks Wall Street. They reported $349.52 million against expectations of just $259.32 million.
Yeah, that is a huge gap.
It's crazy. We are talking about a $90 million upside surprise while the stock is basically priced for disaster. So looking at this glaring disconnect, the stock dropping while revenue just radically outperforms expectations, are we looking at a fundamentally broken company, or is this just a deeply misunderstood transition period?
Well, the data points pretty heavily toward a misunderstood transition, but you really have to look under the hood at the mechanics of what they are doing right now to see why. A $90 million revenue beat is not, some accounting quirk.
No, definitely not.
It signals that the underlying core brand actually possesses a level of operational resilience that the market simply isn't pricing in. The broader market algorithms have been punishing them for headline noise, mostly related to corporate restructuring, but the cash registers at the actual drive thrust, they were ringing significantly louder than the street models projected.
All right, let's move into the wealth building context, because when I look at Jack in the Box, this is clearly not your high-flying tech play.
Right.
We aren't dealing with explosive artificial intelligence growth or semiconductor super cycles. This requires a completely different mindset for you as an investor.
It really does. It requires patience and, honestly, a high tolerance for ambiguity. What we are analyzing here is a classic turnaround and value recovery play. In a well-rounded portfolio, you generally need different profiles, right? Yeah. You have your steady compounders, your growth engines, and your distressed value opportunities. The core investment thesis for a stock like this relies entirely on enduring transitional pain in exchange for asymmetric upside later on. And the primary source of the recent pain and all that headline noise stems from their strategic divestiture of the Del Taco brand.
I want to dig into that divestiture for a second, because from the outside, it looks like they just shrunk the company.
Yeah, it looks bad on paper.
But from an operational standpoint, they sold off Del Taco to strip away distractions and force a pure focus on the core Jack in the Box brand. The problem is, when a company sheds a major asset like that, the surface-level financial numbers just get incredibly muddy.
Oh, absolutely.
Suddenly, top-line revenue takes a hit simply because that second brand is no longer contributing to the balance sheet. And I imagine a lot of passive index funds and algorithmic trading models just see the dropping revenue metric and, well, they automatically initiate sell orders without understanding the context.
That automated selling pressure is a huge factor here. The algorithms aren't necessarily parsing the strategic intent behind shedding a secondary brand. They just see declining aggregate numbers and hit the exit.
Right.
So the opportunity for an active investor is recognizing that temporary headline noise for what it is. The company is actively shedding weight so the core business can run faster. It is a deliberate debt deleveraging and valuation reset happening beneath the surface, but it's totally masked by the messy optics of a corporate breakup.
It reminds me of a homeowner who decides to aggressively pay down a high-interest mortgage.
Well, that's a great way to look at it.
Right, because if you just look at their checking account, they might look completely cash poor. They aren't buying new cars. They aren't going on lavish vacations. And on paper, their liquid assets are draining. but beneath the surface, they are aggressively securing the equity in the home. So the critical question for us as potential investors evaluating this house is whether the underlying foundation, like the business itself, is actually solid, or if we are buying into a structure with termites in the walls.
And the market is absolutely fixated on that draining checking account right now. They are panicking over the short-term cash flow optics while completely ignoring the long-term equity value being secured.
That gives us the bigger picture. Now let's look at the fundamentals. If we are looking for termites in the foundation, we need to transition into the fundamentals and look at the income statement.
Yeah, let's start with their structural moat, because the quick service restaurant space, or QSR, is a viciously competitive environment.
Cutthroat.
Extremely. Jack in the Box operates 2,128 restaurants, but what separates them is their daypart coverage. While titans like McDonald's and Wendy's are spending billions of dollars fighting this margin-crushing, bloody war over the 12 p.m. lunch rush, Jack in the Box is quietly operating a near monopoly at 1 a.m.
The late night crowd.
Right. Their Munchie Meal platform specifically targets that late-night demographic. When it's past midnight, your consumer options are severely limited, and they capture a massive slice of that specific, highly engaged audience.
And they pair that late-night dominance with a franchise-light model, which means they are holding some incredibly valuable real estate assets underneath the burger business.
Yes, very important.
But we have to address the financial reality right now because the recent metrics are a mixed bag at best. The margin compression we are seeing is severe. Restaurant-level margins dropped down to 16.1%, franchise margins declined to 38.6%, and same-store sales fell 6.7%.
Yeah, that's right.
In the restaurant industry, same-store sales is the pulse of the company, and a nearly 7% drop means foot traffic is undeniably shrinking.
A drop in same-store sales of that magnitude is brutal, and it perfectly explains the margin compression. The mechanics of a restaurant model rely heavily on fixed costs. You have to pay the lease, keep the lights on, and staff the kitchen, regardless of whether 10 people walk through the door or 100.
Right. Those costs don't change.
Exactly. So when your top-line sales drop by almost 7%, you lose all your operating leverage. That lost revenue comes straight out of the profit margin, which is why those margin percentages collapsed.
But management isn't just sitting on their hands watching the margins compress, right? They are actively implementing what they call a barbell pricing strategy.
Yes, the barbell strategy.
Looking at how this works in practice, they are basically offering hyper-aggressive, dirt-cheap loss leaders to get foot traffic into the drive-thru, while simultaneously introducing premium, high-priced items to protect their margins. So they use a cheap promotional burger to acquire the customer, but bank on that same customer adding like a high-margin premium shake or loaded fries to the order. Does that math actually work when your foot traffic is already trending down?
Well, the early data from their second quarter suggests the math is actually starting to work. By playing at both extreme ends of the value spectrum, the cheap draw and the premium upsell, they managed to flatten out the decline in same-store sales. More importantly, their adjusted earnings margins started recovering back toward the 20% mark.
Okay, so it's stabilizing.
Yeah. The strategy is designed to stop the bleeding, and their fiscal 2026 guidance explicitly anticipates sequential improvement moving forward, meaning they expect each upcoming quarter to look healthier than the last.
Sequential improvement sounds great in a press release, but I have to push back hard on their balance sheet.
Fair enough.
They posted a net loss in the first quarter, and despite that, management is targeting 4 times net long-term debt to earnings by fiscal 2028. Right now, their total outstanding securitized debt is sitting around $1.5 billion.
It is a lot of debt.
For a company valued where it is, that is a massive burden. Are they cutting this business to the bone just to survive the interest payments?
It's important to look at how they are restructuring that burden because it's highly strategic deleveraging, not a survival panic. They recently reduced their 2026 debt obligations by $236.4 million,
Okay.
which included a $110 million early repayment of fixed-rate notes. Concurrently, they completed a massive $500 million securitization and established a $150 million variable funding facility.
Wait, explain the strategic value of that securitization. Because to a layman, taking on new debt facilities while trying to pay down old debt just sounds like shuffling deck chairs on the Titanic.
I get that.
Yeah.
But by utilizing a securitization, they're essentially ring-fencing their reliable cash flows, like franchise royalties, and using them as collateral to secure more favorable terms.
Mm.
What they're actually doing is buying time. They are paying off the immediate near-term threats and extending their maturity runway out into the future. It ensures they have the liquidity and the oxygen required to let the operational turnaround, like the barbell strategy, actually take root without the immediate threat of a debt default hanging over their heads.
That brings us to the catalyst timeline, because all of these financial maneuvers are essentially just building a runway, but having a runway doesn't matter if the plane never takes off.
Exactly. The catalysts are the upcoming events that will force the market to stop ignoring the stock and reevaluate the fundamental story. And the ultimate test of this entire turnaround thesis arrives in August 2026 with their third quarter earnings report.
Because that is when they have to actually prove the sequential improvement they've been promising, right? If they miss on same-store sales in August, the market is going to punish them severely.
That is the do-or-die moment for the barbell strategy. But alongside that financial test, we have their summer 2026 brand activations. They are celebrating their 75th anniversary, and part of that involves rolling out high-profile collaborations to drive traffic.
Right, the hot ones thing.
Yeah, the most notable one is a limited-time Munchie Meal partnership with the brand Hot Ones.
Okay, let's pause there. I understand the cultural cachet of partnering with a viral YouTube show known for spicy wings. It's great marketing. But we just talked about a $1.5 billion debt load. Is a spicy chicken sandwich promotion really enough to move the needle on a structural financial deficit of that size?
Well, the chicken sandwich itself isn't paying off $1 billion, but we have to look at how the QSR funnel works. The immediate crisis is the drop in foot traffic. A viral, culturally relevant promotion like Hot Ones solves the top of the funnel problem by bringing an influx of younger, highly engaged consumers back to the drive-thru.
Yeah, getting them in the door.
Exactly. Once that traffic returns, the barbell pricing strategy takes over to extract maximum margin from those orders. That improved margin flows down into free cash flow, and that free cash flow is what actually services the debt. It's a sequential domino effect.
So the marketing buys the traffic, the barbell strategy monetizes it, and the resulting cash pays the bank.
That is the mechanism. And concurrently, they are running an initiative called Jack on Track, which targets $35 to $45 million in real estate sales.
Oh, interesting.
Yeah. By selling off underutilized real estate assets, they can directly chip away at that principal debt load while shifting the business further toward that highly profitable franchise-light model we discussed earlier.
Catalysts tell us what could change the story. Now let's pivot to the chart. So if August is the do-or-die moment for this barbell strategy and these catalysts, how is the market pricing that risk right now? Because looking at the chart and the technicals, it seems like the market has already run for the exits. We mentioned that brutal 14% decline over the last 7 months.
That prolonged, grinding decline has pushed the stock deep into a capitulation zone,
where the last remaining hopeful investors just throw their hands up in disgust, sell their shares at a loss, and walk away.
Yeah, exactly.
You usually see heavy selling volume right before the trend chops sideways, simply because the supply of motivated sellers has been exhausted.
And that exhaustion point creates a basing pattern on the chart. The downward momentum halts, the selling pressure evaporates, and the stock compresses. From that compressed base, the tactical upside potential starts to look very compelling. Analysts are eyeing tactical price targets around $16.40, which implies roughly 30% upside from these currently depressed levels.
But the volatility here is significant. We are seeing elevated gap up and gap down activity. And there is a wild card here we can't ignore, right? Jack in the Box recently caught a sympathetic bid during a massive meme stock rally.
Yeah, that was...
When retail traders pushed Wendy's up 25 to 29% out of nowhere, Jack in the Box moved right alongside it. That tells us this stock is sitting squarely on the radar of retail momentum traders, which can detach the price from the fundamentals very quickly.
When you combine a stock that has high short interest, a relatively small float, and sudden bursts of retail attention, the chart can move violently in both directions. This requires a very clear safety reminder for you. Charts show historical probabilities, not guarantees. A basing pattern and sympathetic meme stock rallies do not promise future price moves. You have to manage your expectations, understand the fundamental structure of the trade, and respect the volatility.
So the chart gives us price structure, but what does market sentiment look like? I mean, a chart is ultimately just a visual representation of how human beings are feeling about an asset.
We are seeing a very subtle but critical shift in the sentiment. If you rewind the news flow a few months, it was purely negative, fixated entirely on the Del Taco sale and the declining sales numbers. Now we are seeing a transition toward cautiously constructive coverage. For example, KBRA just issued preliminary ratings validating their financial restructuring.
Which is a huge stamp of legitimacy. When a third-party credit agency validates the debt restructuring, it signals to the institutional debt markets that the company is stabilizing. But despite that, when you look at the Wall Street analyst community, the consensus rating is still a lowly hold.
Yeah, it is.
If the street is stuck at a hold, are institutional investors quietly pricing in this turnaround, or are they just ignoring the stock completely?
They are largely ignoring it, which is a fascinating setup for a contrarian investor.
Mhm.
A universal hold rating means analyst expectations are virtually non-existent. They've set a beautifully low bar. Any positive surprise like that $90 million revenue beat catches the broader market completely off guard because no one is aggressively modeling for success.
Right.
Meanwhile, if you look at the internal sentiment, management has a $175 million stock buyback authorization sitting on the desk.
They did pause that buyback temporarily to prioritize paying down the debt, though.
They did, which is the financially responsible move. But the authorization itself is the signal. The board authorized $175 million to buy their own stock because they unequivocally believe the shares are undervalued at current prices. They're just waiting for the balance sheet to clear up before they deploy that capital.
That sentiment picture is useful, but we still need to talk about the risks. That internal confidence is a strong signal, but we have to thoroughly examine the downside. A cheap stock can always get cheaper. What breaks this thesis?
The overarching threat is execution risk. We discussed that 6.7% drop in same-store sales. If management's barbell strategy fails to resonate with the consumer and those sales declines accelerate instead of stabilizing, the entire turnaround narrative collapses.
But with the stock already down 14%, wouldn't you say a lot of that failure is already priced into the current valuation? The market clearly expects them to struggle.
A significant portion of the struggle is priced in. However, if they report in August and same-store sales have cratered another 8 or 9%, the market will aggressively re-rate the stock even lower. At that point, it implies the Jack in the Box brand itself is losing cultural relevance, rather than just suffering through a temporary financial transition.
I want to highlight another massive risk regarding their interest costs, because the math on their refinancing jumped out at me.
Yeah, it's notable.
The old notes they just retired were carrying an interest rate of roughly 4.47%. But the new $500 million notes they just secured carry a hefty 7.62% coupon. They have drastically increased their cost of capital in a high-rate environment. That higher interest expense is going to act like a vacuum on their free cash flow. How does a turnaround survive when debt servicing costs nearly double?
The higher interest expense will undeniably pressure their free cash flow, and it is the primary bear case argument. However, looking at the total financial picture, it is manageable for 3 specific reasons.
Right.
First, they already paid down $236 million of total debt, so they are paying a higher rate, but on a shrinking principal balance. Second, securing this new debt completely eliminates their near-term refinancing risk. They aren't going to face a sudden liquidity crisis next year. And third, having that extended maturity runway allows the operational turnaround to actually take effect. They're essentially paying a premium interest rate in exchange for the one resource they desperately need, which is time.
So with everything on the table, what's the final verdict?
Weighing the operational improvements against the structural debt, the final rating is a bullish score of 6 out of 10.
So leaning positive, but heavily caveated by the execution risks.
Correct. The final stance is that this is a speculative turnaround play positioned at the point of maximum market pessimism. The timeline here is fundamentally a swing trade leading into that crucial August 2026 third-quarter earnings report. If management demonstrates operational stabilization and the barbell strategy proves effective, this easily transitions into a 6 to 12-month turnaround holding.
And who is the target investor for this specific profile?
This setup is exclusively for investors who are willing to endure significant near-term volatility in exchange for asymmetric upside potential. You do have some downside protection anchored by their massive real estate asset base, but the ride over the next few quarters will be bumpy. If you are a risk-averse income investor looking for steady dividends and calm waters, you need to be very careful here and likely allocate your capital elsewhere.
As always, we have to clearly state that none of this is financial advice. You have to do your own diligence and understand the risks of your own portfolio. And if you want a cleaner way to read trading charts as you do that research, check out VIP Algos through the link below in the description. VIP Algos is an educational TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make charts easier to scan, but it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
Before we go, think about that universal hold rating from Wall Street analysts we discussed earlier. It begs a fascinating question about how you manage your own portfolio. Are your absolute biggest wealth-building opportunities hiding in plain sight in the exact stocks that analysts are too bored to downgrade but too scared to upgrade?